Well, welcome everybody to Write Your Financial Future. Thank you to everybody who's attending today. Not what we had expected, but due to the coronavirus, we were unable to host this seminar at Book Lovers Con. And I know everybody was excited for that, myself included. And unfortunately, that has been postponed at the current date. But at the same time, I wanted to make sure that we had the opportunity to present Write Your Financial Future. And first and foremost, I hope everybody who is attending and everybody else who is associated and affiliated with Midland Financial and your families is healthy and safe during this interesting time. My name is Larry Sprung. I am a certified financial planner and founder of Midland Financial, and I'm going to be your host for today. I have 23 plus years of experience in the financial services industry, 15 of which of operating my own firm. And basically, I have seen everything and anything that you could imagine in this field, and I am here as a resource to you. I work with many authors who have attended this presentation at some point or another prior to and since that time. So I understand your business. I understand what you're trying to accomplish, and it's important to also integrate the financial aspects to that. So before we get started, just keep in mind there is a Q&A area. So if you have any questions, if you rather put them in there than the chat, because the chat could get lost there. If you put it into the Q&A, it will put it in a queue for me and make sure that I answer those. I want to make this interactive, so if you have any questions along the way, please pop them in there and I will address them as we go along, because again, I would like to make this as interactive as possible and make sure that it's as valuable as possible for you, and that is by me answering those questions that you are most interested in hearing about. So with that, I'm just going to move on. The important disclosures, compliance-wise, I have to make this available regarding the disclosures about ourselves and the firm. Feel free to read those at your leisure in the recording as well. So let's jump right in here. Publishing a book. You know, it's a major accomplishment, and the issue is, you know, after you have this success and the royalties start showing up and your income starts coming in and then the tax bills come, you know, who do you turn to? You know, we've ran into people in this industry that have written a book, huge success, and then they have the income coming in and they go out and buy a car for cash or buy a house for cash. And then it's not until March of the next year or maybe April until they realize that they're going to owe taxes on that revenue that they derived. And maybe they didn't put enough aside. So the question is, you know, when you have this start, who are you turning to? Do you have infrastructure in place within your ecosystem that could help you make these very important decisions? And, you know, do you have a game plan for this? So let me share this video with you that I did not too long ago. And
have a financial plan. What we find is many clients prior to meeting us and working with us have spent more time planning their family vacation than they've planned out with their financial life. And by putting together pen and paper and designing and developing a financial plan, it really sets the clients on a path for financial success.
so you have to have a plan. It's, you know, who's on your team? You're going into this, yes, you're writing a book, and many of you, and we'll talk about it in a minute, have an outline, but you have to have a plan. Maybe you don't have this team in place from the very start, but you should have an idea of who you might want on your team. You may need an attorney. You're probably going to need a CPA. You may at some point need an HR specialist, depending upon how big you become as an author. You may need a risk management specialist, a banker, or even a business specialist. And in the heart of all this is you should have a financial advisor, somebody who you can align yourself with that's going to be able to assist you in bringing this team together, bringing in all the resources that you need to be successful and have it work successfully and integrate. We work with a number of authors, and, I look at you guys as a whole, as a chief visionary, somebody who has this vision, and that's your book. And that's really where your expertise comes in, is putting in that in what's needed to build this great piece of art that's going to be able to be consumed by the public. Many folks don't have the business acumen beyond that. Some do, but there are many that don't and really want to focus at what they're great at, and that is the art of writing. So you're going to need a team in place. And if you have the right advisor, they're going to be able to help you pull this team together and help manage it to make sure that everybody is rowing in the right direction for you and in your best interests. So one of the questions I get a lot is regarding business structure. Should I form an entity? What entity is best for me? What are the benefits of forming an entity or the disadvantages? Who would help me set this up? These are all great questions. And quite frankly, everybody is different and everybody is in different stages of their writing careers, if you will. So some of you may be operating as a sole proprietor, bringing in that income on your Schedule C. Some of you may be formed as an S Corp. Some of you may be formed as an LLC. Now, there are benefits and disadvantages to each one of those structures. And depending upon the size and the scope of your writing practice, will somewhat dictate on which one of those entities may be best or right for you. And again, if you run into folks in the industry that say everybody should be a Schedule C or everybody should be an LLC, that's somebody I would advise not taking advice and guidance from, because that is totally false. Everybody's different. Everybody's facts and circumstances operate different. I think a progression typically of somebody in the writing profession is when they first get started, a Schedule C may work very well for them. It may be the most ideal as well. As they become more prolific and better at their craft, generating more sales and more revenue, it's probably going to become important to form an entity as either an S Corp or an LLC. And when you get to that point, there are, again, benefits and disadvantages to each. And one person may benefit more heavily from an S Corp and another from an LLC. The big thing is, who's going to help you do this? Well, typically, an attorney is going to be the best person to assist you with this, but they're going to have to work in concert with a CPA. So the attorney will typically form the entity. The CPA may have some input as to what type of entity you should form, because they know your tax situation best. As an advisor, as the core of that relationship that I showed you earlier, we're typically coordinating with the accountant, with the attorney, to make sure that everybody is on the same page and the entity that is right for you is the one that ultimately gets formed. Okay. Again, keep in mind, I'd like to make this interactive. So if you do have questions, I am monitoring the question box. So feel free to post any questions in there and I will make sure that they get addressed. Tax planning. This is tied in somewhat to the entity. How do I prepare for the taxes on the revenue, and who will help me prepare for this? The money that you generate from your books and your book sales is absolutely going to be taxable income. How that is taxed will depend on what type of entity you are. Schedule C perhaps will be taxed differently than an LLC or an S Corp. But the bottom line is there's going to be taxes owed on the revenue that you generate. There's no way around it. And depending upon how you're structured will depend on how those taxes line up. Your CPA is predominantly the point person for helping you prepare for this. If you're somebody who's been writing for a long time and has a constant inflow of revenue from writing, you potentially will have to pay some type of quarterly tax in order to stay ahead of the game so that you're not hit with a huge tax bill at the end of the year. If you're somewhat newer and don't have a revenue stream that's constant and recurring, you may not be doing that, and that may be fine at this point. But just keep in mind, as you're generating more consistent revenue, you're going to have to pay tax on. Well, you're going to have to pay tax on any revenue, but as you get more consistent, there may be things that you need to do, like paying quarterly taxes to make it more bite-sized for you so that you're not getting hit with a huge tax bill and potential penalties if you wait until your tax filing deadline. And your CPA is by far the person that you're going to work with for this. And again, with us at the center, we're typically working with that CPA in concert to make sure that everything is being handled in the proper way for you. So once you decide that the structure is in place, what structure that's going to be, and again, keep in mind that may morph over time. You may start as one structure or entity, and it may change over time depending upon what happens with your writing career. And once that structure is in place and the taxes are understood, now it's time to start preparing for your happily ever after. We all hear and read about the happily ever afters in books, and now you need to prepare for this in your own way. And everybody has their own happily ever after. So it's important to work with your financial advisor, somebody like us, to help create a clear picture of what this means to you. And what I would suggest is this is not something that you should wait until you hit X number of dollars in revenue. This should be something you do very early on. If you have those goals of hitting certain bogeys or revenue streams or writing a certain number of books, which I would imagine, many writers that we work with are extremely goal-oriented, you're going to want to start crystallizing what this financial plan is going to be, because ultimately this writing career can turn into a financial stability or a source of financial stability for you and your family. So, what does that clear picture look like? Is it saving for your retirement? Is it a child's education? What do you want this money to do for you? What are your wishes? These are all things that should be thought about and structured in a financial plan as you embark on your career. And this is where we go back to what was mentioned earlier in that video. A plan is a powerful tool. Just like you're most likely not going to just sit down and bang out a novel or a novella and with no structure in place. You're going to probably have some kind of outline, character development, just like you would have the outline for your next book or a business plan, or simply map out what you're going to do, what you're going to write. You need to have a financial plan to build and protect your assets for that happily ever after. And again, as I said earlier, it's key that you start thinking about this early. And having an advisor like us putting that plan in place will help you make financial decisions as your career develops. There may be decisions such as, marketing. Should I invest more money in marketing? Well, obviously, if you invest more money in marketing, you want to see that return on investment. And that's money that will not be left in your pocket towards your financial plan. So if you're looking to increase that by X, you're going to want to see, how does that affect my financial plan versus the return on investment? A personal financial plan is something that everybody should have or not, but it's just as important for writers as everybody else. It looks like I might be having a technical difficulty. Can somebody tell me if everything's going smoothly? Because I just got a notice. Okay, great. Thank you. So with regard to a personal financial plan, there are various areas that you need to have expertise in or access to a trusted advisor that does. Okay. There are many aspects to your financial life. There's legal aspects. There's accounting, which we talked about. There's taxes. There's insurance. There's investment management. There's financial planning, as well as human resources. So there are many different facets to putting together this financial plan. It's not just putting in a bunch of numbers and seeing if you're going to have enough money for retirement. Because if you don't make it there and you don't have goals and objectives, it's not going to matter. So you want to have a plan that's personalized to you, that is in line with your personal financial goals and your business financial goals. And, these are all areas. By far, this is not an exhaustive list, but it is a list of key areas that you will need to consider. Okay. Where we excel as a firm, Midland Financial, is in the investment management, financial planning, and the insurance component of life, disability, and long-term care. Those are where our expertise lie. But in those other areas that are outside of our expertise, we have built relationships with very qualified individuals and firms that help our clients through those processes in those areas. So we do not do tax returns, but we have access to a number of CPAs all over the country that we vetted that could assist you with those processes. Legal, same thing. You need somebody legally who's going to be able to operate within the confines of your state or is licensed in that state. So you need somebody who has the expertise or who has access to it for you. So asset management, that was one of our key areas that I mentioned. You've worked hard for these monies that you've earned, and now it's important that you get these assets working for you. Writing is a career that you can do indefinitely. You don't have to retire. It's not potentially physically demanding, probably very mentally demanding. Time regiments, yes. But it's not like being a construction worker where if you do the job for 10 or 15 years, your body's going to be worn down and you potentially, may need to retire earlier. This is something you can do in perpetuity potentially. But now it's important, as you build those assets, pay the taxes, you want to get these assets working for you. And there are benefits and disadvantages of each. So some of the areas that can be utilized are retirement plans, college savings plans if you have children that have yet to go to college, just regular investment accounts, and tax deferred and taxable investing. So just to give you a quick overview, so retirement plans can help you reduce taxes, grow money tax deferred, and have you grow assets in a very tax efficient way over time. College savings plans, similar, depending on your state, there may be different things available. You may get a deduction for putting money in, you may not. The federal rule, which goes no matter what state you're in, the money will grow tax-free as long as you use it for higher education. You obviously want access to some money over your lifetime. You may not want everything locked up in a retirement plan until you're 59 and a half or older. You may not want money locked up in a college savings plan. So a regular investment account is a way that you can have money that's available to you and invested at the same time. And tax deferred versus taxable, basically, if you can put money away for a long period of time and use tax deferred investing, it could be helpful, more helpful to you if you're in a high tax bracket than taxable investing, where you may owe tax on an annual basis on some of the growth, the income, or the dividends that you receive. Risk management. This is an area that gets overlooked by a lot of people, not just folks in the writing community, author, publishing community, but all areas. We're always talking about assets, growing assets, working towards retirement, having enough money for retirement. But it's just as important to make sure that those assets are protected. Your life is protected in case that earning capability goes away. So, you've put in a lot of work for these royalties, your income, your assets. It's just as important to keep them. You've hopefully, if you're at the stage that you've created an entity for your business, one of the benefits of that entity is it protects you personally if something were to go wrong within the entity. Legally speaking, you're protected personally. But what happens if you can no longer write? What happens if it's a primary income for your family and, God forbid, you have terrible carpal tunnel or some debilitating disease that won't let you write? Well, how do you protect yourself? Well, there's disability policies that will allow you to do that. You have to make sure that they're written properly and covering what you need. That's in the case that you can't write. Now, what happens if you're in a situation where you get sick and pass away in an untimely fashion? Well, you want to make sure that your family is protected and maybe protect that income stream. So there may be ways to do that through life insurance. Long-term care, is typically, looked at in the 45 to 60 range, depending upon what your thoughts are around it. That's not necessarily going to protect your working assets, your income stream. It can help protect your assets in the case of needing some kind of assisted living. But the key here is, and the important piece is, you can't just think about accumulating assets. It's great. It's important, but it's just important as devising a strategy to protect your income stream and protect the assets that you've grown and built over time. Estate planning. This is another area that gets overlooked by many. And again, not just from the writer, author, publishing community, by the public at large. People do not want to think about what happens to my money, my assets, my kids, if something happens to me. You've done everything right. You're working on writing your happily ever after. Part of your planning must be to protect your assets and family. How are your assets going to be, distributed upon your demise? How can you protect your estate from estate taxes if that applies to you? How are you going to protect your kids if you or your spouse or both were no longer here? These are daunting questions. They're not fun to think about, and quite often get overlooked because they're not fun to think about. We work with a number of estate planning attorneys who draw up these documents, and I can't even tell you how many people go in for the initial meeting. They even engage the attorney. They draw up the documents. They create the drafts. They're ready to go, and the people don't end up ultimately executing the documents. Not because they don't think they need it. They know they need it because they brought it up into that point. But they don't go in because they're concerned. They don't want to think about something happening to them. Well, I look at things the other way. I would much prefer you have these documents in place. okay, and hope they never get used. But at least if they're in place, we know that your wishes will be followed through on and considered. Because I will tell you, in many states, I know here in New York, for example, if you don't have a will, you don't have directives, the state has already made a decision for you on all of these questions. What happens with your assets? What happens with your kids? So unless you want to leave that up to the state and not have input into that, especially in New York, I advise you to check with your own state, because they may have similar processes in place also. You're going to want to make sure this is done. So and when it comes to money, if something were to happen to you, I assure you it causes, unfortunately, more trouble than not. We see a lot of issues arise, even with sometimes the best laid out plans. But when there's no plan, it causes a lot of infighting in the family. And, we don't want to see that happen to you or our clients. So somebody just shared with us that somebody just had this happen where their publisher died and everybody went to probate over their royalties and rights. Another thing to consider is, who are the people that you're working with? What happens in the event of something happening to them? A continuity plan. Give you an example. My firm, right? We have a succession plan in place. I am a primary advisor. I have support people, but I am the face of the firm. We have a plan in place that if something were to happen to me, I call it the proverbial hit by the bus, that a firm will come in and purchase my entity, my firm, and continue to manage it. They're a very large entity, many advisors, they have their own internal succession plan, so my clients will not face that again. And that's important. You want to make sure that the folks you're dealing with have their own succession plan in place, so you don't end up in a situation that you don't want to be. Point here, thank you for sharing, by the way. And the important piece here is, just like any other planning, the estate planning is just as important as any other planning that you're going to do. I'm going to share this video with you. Just give me a second to pull it up here. One of the things that I recommend is who you're going to work with as that hub of your situation, the investment advisor, the financial advisor, is make sure they're a CFP, a certified financial planner. Okay, there are only about 83,000 of us nationwide. Only about 10 or 12% of the entire financial advisor community is a CFP. The main difference is we have a different methodology of thinking, and we look at the big picture for clients first, planning centric first, product second. We are less product driven. We're not salespeople for the most part. You go to some firms out there and basically their first answer to any of your questions is you need to buy this or buy that. CFPs typically start from a planning strategy first and then figure out, okay, based upon your plan, what products, what investments can we use to get there? And here's a little spoof, if you will, that sheds light on the certified financial planner versus a regular financial advisor.
Let me talk to you about retirement. 401k is the most sound way to go. Let's talk asset allocation.
Sure.
You seem knowledgeable, professional.
Would you trust me as your financial advisor?
I would.
I would indeed.
Well, let's be clear here. I'm actually a DJ.
No way.
I have no financial experience at all.
That really is you.
If they're not a CFP pro, you just don't know. Find a certified financial planner professional who's thoroughly vetted at letsmakeaplan.org. CFP. Work with the highest standard.
Now, that makes a joke about a certified financial planner, but in a lot of regards, it's true. If you're going to work with somebody, the certified financial planner typically has been vetted. There's a testing process. There's an education component that you have to go through. Then there's a testing component that you have to go through. And then every 2 years, you have to satisfy 30 hours of continuing ed credit. So there's a higher level of responsibility there as far as being a certified financial planner. There has been vetting by the Certified Financial Planner Board. Other advisors that are not CFPs have not necessarily gone through that vetting process. And I will also tell you a little bit more in a moment. There are ways to check out your financial advisor, because I've seen situations where folks have, been working prior to us with advisors, and I do a quick check, just like they could, and we find out that they have, 5, 10, 15 lawsuits against them. And I would imagine, if somebody's been in the business 30 years and they have one mark against their license, I'm not as concerned, because it could have just been a bad situation, one bad client over a 30-year period, or bad situation over a 30-year period is not alarming to me. But once you start seeing multiple 5 and 10, it becomes more and more of a concern for me, and should be for you. So one of the things that I want to share with you is, and this is where I think the public in general, and again, not just the author, publisher, writing community, doesn't understand this, but there are typically 2 different types of advisors out there. You have folks that work as brokers, which is on the left side of this slide. And on the right side, you have RIA, which stands for Registered Investment Advisor. Okay. I'm just going to give you a kind of a high level view of this. So brokers and RIAs, I'm just going to use that for short, have different levels of responsibility to their clients. A broker simply has what's known as a know your client rule, or know your client, know your customer. Basically, you have to tell them what your income is, your net worth, what your risk tolerance is. And as long as they make a recommendation that fits their knowledge of you, they're basically satisfying their obligation as an advisor to you, and can sell you the product that they want to sell you, as long as it fits those parameters. As an RIA has a fiduciary responsibility to their clients. Sounds like similar, but it's much different. Fiduciary means, as an RIA, we have to act in our client's best interest. The client always comes first. Other professionals that have to work as a fiduciary, for example, are a CPA, a medical practitioner or doctor, and a lawyer. They all are fiduciaries, have to act in their client's best interest. Now, you're probably saying, well, why don't advisors have to? And I agree with you. I think it is absolutely nuts that people in this industry who are helping guide folks on their assets, their livelihood, their retirement nest eggs, do not have to act in their client's best interests. But this is the way it goes. So it's important to find out, if this is important to you and you didn't realize this before, you're probably going to want to find out if your advisor, if you have one, is a fiduciary or a broker, because they're very, very different. And I will tell you that there are some firms out there, large firms, that their advisors are licensed and registered in both capacities. And we've even seen it in instances where clients have a brokered account and an RIA account. So if you look on the left, the brokerage account versus the investment advisory account, we've seen folks with the same advisor having, let's say, one of each. Now the question begs, well, when you're talking to that advisor, are they talking to you as a fiduciary or as a broker? In my view, the water is too muddy there, too cloudy. I don't feel that somebody should be able to work in either or capacity. It should be one or the other, and they should disclose under all circumstances in what capacity they are working with you. So, just to look at some of these, if you look at some of these, typically the brokers are large corporations, RIAs, some are large, but mostly locally owned, account placement. They're linked to a broker, parent company. In the case of an RIA, many choose a platform that is best fit for their clients' needs. The investment decisions, usually the broker will rely on their parent company to help with recommendations, and the RIAs are more independent in nature. Again, you have to always act in your client's best interest. The legal standard here, this top line, this is what I spent most of the time talking about because I think it's the most important. Why in God's name would you want somebody working for you that doesn't have to act in your best interest? I'm very passionate about it, and I think everybody should work with a fiduciary first. Unfortunately, a lot of people don't know the difference, but it's becoming more well known, and people are becoming more knowledgeable about it. The compensation, which is the next line down, works very differently also. Brokers are compensated for sales. They sell you a product, they receive a commission. So they sell a mutual fund, the mutual fund company pays them a commission. In most cases, you're paying that commission. You may not necessarily see it. Okay, it may not be easy to find, but you're paying it. If you are in that situation, if you have questions about it, where that money is coming from and how you're paying it, be more than happy to point it out. But typically, you're compensating that advisor for the transaction, not the advice. Whereas on an RIA side, they're typically charging an asset under management fee or a retainer fee or some kind of fee that gets billed directly to you, the client. So the other difference is the broker side, they're getting compensated by a product provider. Okay, there is an inherent conflict or potential for conflict of interest. If one provider pays higher commission than another, that could skew them in the wrong direction. With regard to the RIA side, we are only compensated on the investment side directly from our clients. So we're not motivated by any mutual fund company, one product or another, because it doesn't matter. We're not receiving any compensation from those product companies. We're receiving the compensation directly from you, our client. Disclosures, limited on the broker side, full disclosure on the registered investment side. Proprietary products, this is another big thing. A lot of firms in the brokerage world have their own proprietary products, which typically pay them more because they manage it. The costs are less. They're able to pay out more, which again is a conflict of interest. And on the registered investment side, typically there are no proprietary products. Okay. And education wise, there is a little bit of a difference there. On the RIA side, we find that many more advisors are CFPs, and they have more of a financial planning background than a sales background per se with regard to the broker side. So that's kind of it in a nutshell as far as the broker versus RIA. I know that it sounds like a very fine line, but it's actually a very different methodology for operating. And I would encourage all of you, if you have somebody already, make sure you're working with an RIA. It's a much better relationship for you in the long run. And if you're looking and exploring to go that route to help you, again, I think the RIA route is a much better route to go. That's basically what I have for today. I'd be open. I don't see any questions in the queue at the moment. If you have one, I would welcome any questions that you have. I'd be happy to take them and answer them, because chances are if you have a question, somebody else on here has a question as well. So I'll just throw one out there right now. I tend to get a lot of questions around the structure piece. Okay. And again, if you can't find the Q&A area, then feel free to throw in the question in the chat and I'll address it as well. But, I get a lot of questions around the structure piece. And again, it's very personalized. And without knowing your own situation and knowing your tax situation, it's hard to discern what would be best for you. And that's really where that accountant comes in and the lawyer to make sure that things are done right for you. Another question that I get a lot is regarding taxes. How much should I set aside? And again, this is, I'm not trying to skirt the question. It's very personalized, because if you're married, for example, and your significant other has income, your need for putting money aside because you have a dual income may be different than somebody who only has a single income of half of what your dual income is. So it's, again, very personalized. The important piece there is that if you start writing and seeing those revenues start coming in, it's going to be very important that you consult ahead of time with your accountant to find out what amount that they would be comfortable with you putting aside, so that you're prepared when the tax bill comes. Okay. So again, I'll give you another minute here. If you have any questions about the presentation, or I will also, be more than happy if you have questions about what's going on in the markets in general. If you have investments currently, obviously these are interesting times with regard to that. And if you have investments currently and, you're concerned or have questions about that, I'd be happy to answer those as well. So I'm going to give you a minute here if you want to type in a question or two. If not, then we'll wrap it up. And, I give you all the opportunity to email me directly. I'll put my email address in the chat box right now, so you have it. It was also on the invitation, and it will be on the follow-ups. If you email me there, any questions, if you have something specific, personal that you didn't want to ask in this group environment, I'd be more than happy to help you. If you're looking to vet somebody, an attorney or another professional, I'd be more than happy to help you there as well. If you have questions on your own individual portfolio, one of the things we've been doing a lot of over the last week or so, while we've been going through this economic uncertainty, is having a lot of conversations with clients and looking at where they are and where they want to be, and recalibrating and taking a look at that. And I think one of the things that I've learned over the last week and a half to 2 weeks is that there are a lot of advisors out there that, number one, either haven't seen an environment like this, or number two, are deathly afraid of the environment we're in, and they're paralyzed. They're not reaching out to their clients. They're not providing feedback, not answering questions. I will tell you this. We are here. We're fielding questions every day. We're fielding phone calls. I'm not hiding under a desk. I've been through this before. Not this exact situation. This is 1,000% unique. But in my career, 23 plus years, I've seen at least 4 or 5 of these downturns. And it goes back to those original slides and that video about having a plan, having a financial plan. If you have that plan in place, okay, and you set it up, and you address it and review it on an annual basis, and you follow that plan, whether we go through an environment like this or a correction like we saw at the end of 2018, that should not cause you to abandon your plan. Unless your goals, facts, and circumstances have changed, it should not cause you to abandon your plan. It may cause you to revisit it and rethink it, but it shouldn't cause you to abandon it. And we're seeing a lot of people who are very fearful abandoning their plan right now, and they're going to feel very good in the short term. But I assure you, in the next 6, 12, 24, 36 months, it will probably, looking back, be the wrong thing to do. So we're here for you, whether you're a client of ours or not. We are here to help you. And we will offer you a free review of anything that you need, no obligation, no charge. I know that a lot of people say no charge, no obligation, because we find that sometimes minor adjustments can make major improvements. And all that we ask is, if we help you out, maybe consider working with us. Maybe not. We'll tell you if you're in good hands if you are. And if not, maybe you have friends, family, or other people in your community that would benefit from our services, and we would welcome the introduction as well. So I thank you for your time. I hope you found this valuable. There will be a survey coming to you, so please fill that out. I love your feedback. You will also get a copy of this recording. And again, I leave it open for you to contact us. My phone number is on this last slide. You can call us directly there or email, whatever's best for you. And most importantly, in the coming days and weeks, to you and your families and everybody around you, we hope that you remain healthy, most importantly, because without that, none of this presentation matters. So please maintain your health, and we hope that everybody manages safely during these unique times. Thanks again, and remember, make it a great day.